welcome to a brand new episode of Smart Money. Now, the market has done well for itself. In fact, we closed above the 22,000 level on the index this week. And the big question we're asking is the pullback that we saw, or is the volatility behind us? We have a couple of big cues to watch out for, which is, of course, the upcoming elections in the next few months, as well as the earnings season, which is now behind us. Our guest today is Gautam Duggad. He's the head research institutional equities at Motilal Oswal Financial. He's been tracking the markets for over decades now. So we're going to find out how you should wade through this volatility. Gautam, thank you so much for joining me on Smart Money.
Thank you.
Well, the next big trigger for the market, right, will be the general elections in a few months from now.
Yeah.
And I think the mood is of the NDA government coming back to power for the third straight time. You have observed many elections in the past. This time, what is your expectation as per the pre-poll surveys?
So, Sonia, thanks for inviting me. I think as far as politics is concerned, it's always difficult to predict. But if you go by the surveys which have come in, I think last week there were two big surveys which have come in. One was from Times Now, I think, and one was from India Today. So, two pretty big pre-poll surveys which have come in. Both of them have predicted somewhere about 330 to 360, which is well above the majority mark for the NDA. Post the December round of state elections, I think market has anyways been discounting the possibility of political continuity, which is basically for the third consecutive time, we are having a majority government led by a single party. Now, this has not happened for ages. The last time you had a single party majority government under the same prime minister, I think was in early 60s during the first prime minister's regime. So if that were to happen, it will definitely be unprecedented, because when the first time you saw full majority coming in 2014, it happened after almost, you can say, 30 years that we had a single party rule, because the 30 years we had the coalition era, almost 30 years. So if you go by the current mood, if you go by the trends which are coming in from different polling agencies, it does suggest that there is going to be a political continuity, which augurs well for market, because it obviously helps you in driving the policy. Policy momentum continues. There's no disruption in that sense. And obviously, that is what market, I think, has been liking. You saw December, after the first round, after that state election round in the first week of December, you've seen almost 8% rally happening in market. Right, and that also led to a sharp swing in the FII inflows. You saw $8 billion coming in just in the month of December. Obviously, you saw some outflows in January. And I think if you combine that with the macro and micro tailwinds, I think the overall structure of the market looks quite decent from that point of view.
But don't you think to a certain extent some amount of this good news is already in the price, and maybe the FI money that had to come in already has? Because, we've seen the market run up so much in anticipation of the fact that after the state elections, I think a lot of people expect the general elections to play out in favor of the NDA government. So don't you think a lot of it is in the price?
Some of it definitely is in the price. But today you have to look at flows as a percentage of market cap. Very little has come in actually. Last year, you've seen some amount of money come in, I think about $22 billion, that is CY23. But prior to that, in CY22, you had seen almost $17, $18 billion of outflows from FIIs. So if you add up CY22 plus CY23, you've hardly seen $5 billion of inflows. Very few markets globally currently are as attractively poised as India, whether it is on macro front or micro front. If you look at macro, you're growing at 7% plus. Give or take 10-20 basis point. Your inflation trends are moderating. Your current account deficit is in control. Crude prices are behaving. 10-year GSEC yield is in a nice range, and currency is stable. And then you add to that, the corporate earnings have been quite resilient. So very few markets today in India, in the global scheme of things, are offering such a strong confluence of macro and micro. And then if you add policy and political continuity to it, then India becomes a very attractive market. I think we've not seen any flows yet as far as FIs are concerned. And forget that. I mean, our market has moved away from those days where market was completely dependent on the direction of FI flows. If you look at the similar 2-year period between CY22 and CY23, you've seen almost $55 billion of inflows from domestic side. You saw 32 in CY22 and last year again $22 billion. And that continued in CY24. First month of CY24, you've already seen about $3.5 billion of inflows from domestic side. So that engine is on. Monthly $3 billion, $2.5–3 billion you're getting from the domestic side, all things put together. If you were to add up other instrument of flows, which is the Provident Fund, insurance, AIF, PMS, and other family office, and all of that put together, you're talking about almost a $3 billion per month kind of an inflow in India, just from domestic side.
Okay.
If you add up $25–30 billion of FI flows, you're talking about $55–60 billion of inflows in CY24. While the absolute number may look quite disproportionate, but as a percentage of free float market cap, it is hardly anything, right? So I think while some of it is already in the price, given the way earnings have shaped up, I think this momentum can continue. The only thing worrying right now is the broader end of the market, which is the mid caps and small caps. That looks quite extended in terms of valuation versus the underlying fundamentals.
You know, you said earnings, right? So that's the other big trigger for the market, the growth that we are seeing in terms of earnings. Earnings season is just behind us.
Yeah.
What are the big takeaways or the lessons that you've learned from this earnings season that you can perhaps base your next investment decision on?
So Sonia, if you look at the earnings which just concluded yesterday, if you look at a broad top-down view, we were expecting about 20% earnings growth for our coverage universe and 10 to 11% for Nifty. Actual number which came in was 30% for our coverage universe and 17% for Nifty. So at a very top-down level, earnings have been better than expectations. And many sectors participated this time. Auto, pharma, financials, within which PSU banks have beaten expectations again. You had very strong earnings coming from global commodities like metals and oil and gas. The only sector which disappointed to an extent was the low-end consumption, retail, EMS, and tech. But tech was in line with expectations, even though it was flattish. So you've got about 30% earnings growth if you look at our coverage universe of 250 stocks. Nifty, 17% growth. We were expecting just about 10%. And more importantly, if you look at the forward revisions, for Nifty at least it was quite stable. You know, we started the quarter at 975 for FY24. We've ended the quarter at 975 rupees of EPS for FY24 for Nifty. And for FY25 also, it is quite stable at about 1140. So we are still talking about a 20% plus earnings growth for full year FY24 and about 15 to 16% for FY25. What was a bit concerning was the earnings revision in the broader market ex of Nifty. That is where the number of downgrades were almost 2x of the number of upgrades if you look at our coverage universe. That was the only sore point. Otherwise, earnings were quite resilient this quarter as well.
That's great to hear. Actually, earnings were better than expected as well overall. In the break, we were talking about the automobile sector, right? It's been one of the best performing sectors this week. And stocks like Bajaj Auto, TVS Motors are at fresh highs right now. Is it worth investing into them despite the rally that we've seen? And what's your big takeaway from earnings?
So Sonia, as far as auto is concerned, it has turned out to be once again the best performing sector, 5th or 6th quarter in a row, insofar as the earnings delivery is concerned. Going into the earnings season, we expected our auto coverage universe to do about 34–35% earnings growth. Actual number was 60%, led by Tata Motors, Maruti, Bajaj Auto. More importantly, if you look at the Nifty auto companies, there are 6 auto companies in Nifty. All 6 of them have either met expectations or a beaten expectation. Not a single company is disappointed. More importantly, auto in our entire coverage universe has seen the highest earnings upgrade. So we have seen our Nifty auto earnings upgraded by about 7%, right, between the preview and the review. As far as the next 12 or 24 months are concerned, I think large part of the big swing in the earnings is already in place in FY24. After staying flat for 5 years between FY18 to FY23, auto earnings has doubled in FY24. On this base, now we are expecting 10 to 15% earnings growth, which is still very strong. And second important point is your margin picture is still looking reasonably okay. While you have benefited a lot across sectors in FY24, FY24 was a year of a big margin recovery. This year you're getting top line growth hardly of 4 to 5%, but your earnings growth is somewhere about 30% for our entire coverage universe. While auto, the earnings growth was almost 100% for FY24. This may not obviously continue because you will now be catching up with the high base, but the sector still looks quite attractive. We are holding M&M in our model portfolio. We still have Ashok Leyland, and in the past we also had Craftsman in our model portfolio. Secondly, we've also published Hero as a top idea of the year for CY24 from our coverage universe. So that's the view as far as auto is concerned.
So on the EV side, I wanted your thoughts because, you know, all this latest news flow about Ola going ahead and sort of slashing their prices of their EVs. The entire EV pocket is not growing as fast as perhaps what one would have expected, especially EV two-wheelers. Now, in this space, names like TVS have done very well. The iQube has done exceptionally well, and that stock is at a fresh high. What do? You think the run is done here?
See, Sonia, it's always very difficult when the stock has tripled in the last 2.5 years. So possibly the stock may not go anywhere. It may remain sideways for next 6-12 months. We don't know how things will shape up in the short term. But the underlying earnings delivery has been very phenomenal, even for TVS. They've consistently delivered, I think, more than 10.5% EBITDA margins now for last 3-4 quarters. Plus their volumes have been quite solid, as you mentioned. As far as EV is concerned, while EV has a long road ahead, but I think both EV and ICE vehicles can coexist in the near to medium term. So I don't think market is necessarily driving derating of auto companies because of the threat of EV. Because the threat of EV or the potential of EV is now well discounted. Everybody knows about it for last 3-4 years. But despite of that, auto sector's fundamentals have remained very robust. Underlying earnings have been quite healthy. And the market cap creation has been humongous in the last 12-18 months as far as auto is concerned, whether you talk about a 2-wheeler pack or a 4-wheeler pack or even a CV pack. Barely any maybe 1 or 2 auto companies, if you keep aside, most of the auto companies have delivered excellent performance over the last 2.5 years.
Okay, so that's a strong case being built for the auto sector. But I also want to ask you about the banking space and your thoughts on the earnings and, of course, what to do with names like HDFC Bank. But more on that coming up after a very short commercial break. Don't go anywhere. We'll be back on Smart Money in just a bit. Welcome back. You're still watching Smart Money. So we're chatting with Gautam Duggad. He's the head research institutional equities at Motilal Oswal Financial Services, and he's talking about all the big triggers that you need to watch out for from here on. The markets are in a great place. We ended the week on a high. But let's talk about banks, right? Before the break, we were chatting about that. This has been one of the tough quarters for the banking sector, and HDFC Bank is just refusing to perform. What do you do at a time like this, Gautam?
So, Sonia, as far as we are concerned, for last 2 years, we've been significantly overweight on PSU banks. And one of the reasons for that was there was a lot of leeway for credit cost to improve. And at the same time, valuations were extremely cheap. 2 years hence, earnings have gone up 2x, 3x, 4x for PSU banks, and they're still trading at 1.2x. Right? SBI, we just wrote a note 2 days back, it's still at 1.2x. Our overweight stance on PSU banks so far has been vindicated. And it looks like, as far as the next foreseeable 3-4 quarters are concerned, you're talking about 13-14% credit growth for the system. While credit cost best is in the price, but you're not seeing worsening or meaningful worsening of trends in any segments. Right? So PSU banks today are delivering 18 to 20% ROEs. Last time they did this was 15-17 years back. And that also happened for 1 or 2 years. Here, already 2 years you have seen 13-14% ROE. This year they will be doing 17-18 to 20%, and we are expecting that to continue at least for FY25 and 26. So we still believe that PSU banks have a room to outperform private banks. As far as private banks are concerned, as far as our model portfolio is concerned, we are overweight on ICICI Bank and Axis Bank, while we've kept HDFC Bank slightly underweight for some time now because of the the underlying merger and some uncertainty as to how the NIMs will pan out, how the deposit growth will pan out. But let me tell you, HDFC Bank today is trading at 1.7, 1.8 times. This is a bank which 4 years back used to trade at 4x. So, near term, nobody can predict, but a franchise like HDFC Bank trading at 1.8x and still doing 17-18% ROE, fundamentally, you would go and buy it. Unless you have a very short-term view. Short-term, you cannot predict. Maybe a quarter or two, you will still...
So you're saying this is a good time to buy HDFC
I would
Bank?
definitely feel so, given the valuations at which it is trading at, and given the negativity which a lot of the street has built on in this name. Okay. As far as our portfolio is concerned, we are still heavily tilted towards PSU banks and NBFCs within the financials. As far as this quarter is concerned, earnings numbers were quite strong. We were expecting a flattish earnings for PSU banks. We got almost 22% growth. And for private banks also, we got about 22-23% growth, which was in line. Right? Yes, but aside of earnings, there are a lot of things which people are bothered about in banking sector, which is the liquidity and the cost. It is, accruing on the balance sheet for the banks because the credit deposit ratios are elevated for many of the banks. So how do they grow, right, without impacting the margin? So that is one thing which is uppermost in the minds of investors. So that is what is keeping people slightly on tenterhooks, and it's been an underperformer for some time now.
Okay, it's interesting you say that this is a good time to be looking at HDFC Bank considering the underperformance. But what are the other stocks that you would prefer now? Post-earnings season, what stands out for you as buys and what would you avoid?
So, Sonia, if you look at the kind of revisions we had done a month and a half back in our model portfolio, we have adopted a very diversified approach. So we have a lot of PSU names also. SBI and BOB we have already spoken about. We had added HPCL, we had added GAIL, we had added Coal India, which incidentally is also part of our top CY24 ideas. Their numbers have been phenomenal. And of course, the entire PSU rally, some of these stocks have also done well. As far as we are concerned, we are still overweight on NBFC, PSU banks, industrials. We have a big overweight on real estate and then consumer discretionary. Within consumer discretionary, we own almost 7 stocks, while in staples, we have just 1 stock. So total 8 consumption stocks, but 7 are discretionary, within which we have names from jewelry, hotels, Zomato, DMart, Metro and all. And then we are neutralish on pharma, energy, and underweight on IT and metals. So that's how we've constructed our portfolio, but more tilted towards domestic cyclicals. And of course, we are also selectively playing the recovery plays in IT and consumption.
Okay, and you want to just take us through what is your overall view on India? I'm asking because, it has been a volatile stretch, right, the last couple of weeks. And now anyone and everyone is bullish on the market. And that's generally when you start to get a little bit of a corrective phase in the market, when this euphoria kicks in. What is your view? What is the best way to approach the markets now?
So I think, Sonia, there is no euphoria in large caps. If you look at Nifty today, even at 22,000, we are talking about 19.5 to 20 times 1 year forward earnings, which is well in line with the long period average. The 10-year average price to earning ratio of Nifty is 20 times. We are at 20 times. So in Nifty, I don't see any euphoria. Do remember that the new highs or the new index highs, whatever you want to call it, a new market cap, are driven by the corporate earnings. 4 years back, Nifty earnings were about 3.5 or 3.4 lakh crore. We are ending FY24 at 7.6 lakh crores. So it's almost a 22% earnings CAGR for last 4 years. If you look at our broader coverage universe, our profit pool used to be 4 lakh crores in FY20. We are ending FY24 at about 11 lakh crores. So that's a 27% CAGR. So while markets are at a new high, corporate profits are also at a new high. Yes, some segments of the market definitely look overextended, especially the mid-cap index, where the valuations today are at a 40% premium to Nifty. If Nifty is trading at 20 times, Nifty mid-cap index is trading at almost 28 times. So you have to be very selective there, do your homework, take a very bottoms-up view. But overall, India, like I said in the beginning, we are enjoying the best of both the macros and micros. Very rarely you see this confluence happening. And the fact that investors are disenchanted with China, we obviously tend to be a collateral beneficiary of that.
Also now Japan has gone into a recession.
Yeah, but Japan as a market has done really well in the trailing 12 months. But look at the weight of India. It's almost gone from 7-8% to almost 18-19% now in MSCI, while China's weight has halved in that same period. So I think unless we see a situation where something goes wrong at a macro level, whether it's elections or whether it is rate or inflation, or you see sudden slowdown in earnings, I think we should chug along well, at least compound in line with earnings. Our expectations for earnings next 2 years is about 15 to 16% CAGR after the last 4 years CAGR of 22%. So even if you build in some amount of derating, you're still talking about a 12-13% compounding for index like Nifty, which is not a bad situation to be in after having already met 22% compounding.
Okay, well, that's a very strong case being made for the market to move higher. But we've run out of time. We would have loved to chat some more. Gautam, thank you so much for joining us and making it to this special episode of Smart Money. With that, it's a wrap on Smart Money. Thanks a lot for watching. Have a great weekend.